We are watching Beyond Meat Inc., ticker symbol BYND, right this second, and the live price is sitting at exactly 1.02 US dollars. The stock is currently showing an aggressive intraday surge, up $0.16 or roughly 19.01% on the day. This is a violent move to the upside for a stock that has been battered relentlessly over the last few months. And the volatility we are seeing at this very moment is not just standard market noise. It is the sound of a battleground being drawn between deep-value distress investors and the relentless pressure of institutional short sellers who have been betting on this company's total collapse. If you are looking at the chart, you see a massive green candle pushing through the psychological $1 barrier, a critical level that Beyond Meat must hold to avoid the existential threat of exchange delisting notices. The volume is pouring in, far exceeding the average daily turnover, which tells us that this is not just a retail drift, but a coordinated liquidity event. Most people looking at this chart see a dead cat bounce. The expectation from the broader market, especially after the catastrophic debt-for-equity swap we saw recently, is that Beyond Meat is in a death spiral, destined for bankruptcy or a fire sale acquisition for pennies on the dollar. That is the consensus view, that the brand is faded, the balance sheet is broken, and the recent dilution has rendered the equity worthless. But the reality playing out on the tape today forces us to challenge that narrative. The reality is that when a stock is shorted to this degree, when the bearish sentiment becomes so unanimous that borrowing costs skyrocket and every accessible share is sold short, the slightest spark of buying pressure can ignite a mechanical squeeze that has nothing to do with selling veggie burgers and everything to do with market structure. What we are witnessing at $1.02 is a test of the maximum pain theory, where the market seeks to punish the overcrowded short trade before potentially resuming the longer-term trend. The expectation is zero. The reality is a fight for survival that could offer one of the most volatile trading opportunities of the month. Let us dig deeper into what is actually moving this price today. The price action you are seeing is a direct response to a sudden shift in retail sentiment and potentially algorithmic covering. After the company flooded the market with over 300 million new shares to settle its convertible notes, the stock collapsed to historic lows, trading well below the $1 mark. Investors were diluted, morale was crushed, and the bankruptcy jackpot shorts piled in. However, the movement today suggests that the selling pressure has exhausted itself temporarily. When you have a stock that has fallen 99% from its all-time highs, the risk-reward ratio for new short positions becomes incredibly dangerous. A move from 50 cents to $1 is a 100% gain for a buyer, but it is a face-ripping loss for a short seller who got greedy at the bottom. The surge to $1.02 is significant because it reclaims compliance territory with the Nasdaq exchange rules. If BYND can close above $1 and hold it for 10 consecutive sessions, it removes the immediate overhang of a delisting warning, which in turn forces algo-driven short strategies to cover their positions, adding fuel to this fire. We need to address the elephant in the room, which is the massive dilution event that brought us here. The recent restructuring deal was a desperate move to clear the debt maturity wall, but it came at a terrible cost to existing shareholders. By swapping debt for equity, Beyond Meat essentially reset its capital structure, but in doing so, they dramatically increased the float. Usually, this is a death knell for a stock price. However, the contrarian take here is that the company has bought itself time. They have kicked the can down the road, removing the immediate threat of a default event in exchange for a lower stock price. For a trader, this changes the thesis from imminent bankruptcy to distressed zombie company with a pulse. That shift in perception, however slight, is enough to drive the kind of 19% rally we are seeing today. The market is realizing that the lights are not turning off tomorrow, and that realization is forcing a repricing of the immediate risk premiums. This brings us to the critical topic of short selling, which is the dominant force in this equity right now. Beyond Meat has long been a favorite target for short sellers due to its deteriorating fundamentals and cash burn. Currently, the short interest as a percentage of float remains astronomically high. If you are holding the stock or thinking about trading it, you must understand that you are swimming in shark-infested waters. The cost to borrow shares of BYND has been spiking, which is a classic indicator of a crowded short trade. When the cost to borrow exceeds certain thresholds, it becomes expensive just to hold a short position open overnight. This creates a time bomb for bears. They need the stock to drop fast to cover their borrowing fees. If the stock goes sideways, or God forbid rises 19% like it is doing today, those shorts are forced to buy back shares to close their positions and stop the bleeding. This is the mechanics of a short squeeze. It's not about the company selling more veggie burgers, it's about shorts running for the exit simultaneously. However, you must be extremely careful. While the squeeze mechanics are valid, the fundamental bear case is still incredibly strong. This is not a company that has fixed its core problem of falling demand. The plant-based meat sector has cooled significantly from its peak hype cycle in 2019 and 2020. Inflation has made premium-priced meat alternatives less attractive to the average consumer, who is struggling to pay for basic groceries. Real meat is often cheaper than Beyond Meat, and in a high-inflation environment, ideology often takes a back seat to the wallet. The bears argue quite correctly that unless Beyond Meat can reach price parity with animal protein, they will remain a niche product for a shrinking demographic. Furthermore, the recent trademark litigation loss involving damages of nearly $40 million adds another layer of cash flow stress that the company simply cannot afford right now. The shorts are not wrong about the business difficulties. They might just be wrong about the timing of the stock's final capitulation. Let's pause for a second and look at the actionable data you need to watch. If you are in this trade, you need to be monitoring the fails to deliver data. When a stock is heavily shorted and hard to borrow, you often see a spike in fails to deliver, which occurs when a seller does not deliver the securities to the buyer within the standard settlement time frame. A high number of FTDs in Beyond Meat would signal extreme stress in the plumbing of the market and could precede a forced buy-in event regulation. You should also be watching the options chain. If you see a massive spike in call volume at the 1.50 or $2.0 strikes, it indicates that traders are positioning for a continued squeeze. Conversely, if the volume is all in puts, the market is betting this rally will fail. Comment below how many shares of Beyond Meat you currently hold or if you sold drastically during the recent crash. I want to know if you are holding the bag or if you bought the dip. Now, let's zoom out and look at the company itself, beyond just the stock chart. Beyond Meat was once the darling of Wall Street, the company that was going to change the world by replacing animal agriculture. Their IPO was one of the most successful in history, popping from $25 to over $200 in a matter of months. They had partnerships with major fast food chains, celebrity endorsements, and a narrative that seemed unstoppable. What happened? The trough of disillusionment. The novelty wore off. Consumers tried the burgers, some liked them, some didn't, but the repeat purchase rate didn't match the lofty growth models analysts had built. Competitors entered the space, undercutting on price. But the biggest issue was the execution on the health narrative. Critics began pointing out the high sodium content and the highly processed nature of the product, stripping away the health halo that justified the premium price. Today, the business model is in a state of radical pivot. They are cutting costs aggressively, slashing their workforce, and pulling back from unprofitable international markets to focus on core liquidity. They are trying to launch newer, cleaner versions of their products, like the Beyond 4 platform with avocado oil, to win back the health-conscious crowd. But turning a ship this size around while it is taking on water is a monumental task. The recent earnings reports have shown shrinking revenues and continued losses, which is why the stock is at $1 and not $100. The bull case requires you to believe that the plant-based shift is a multi-decade trend and that Beyond Meat, as the category leader with the strongest brand recognition, will be the one left standing when the weaker players fold. It's a last man standing thesis. If they can survive this liquidity crunch, they own the category. If they can't, the brand gets sold to a conglomerate like Nestle or Tyson for parts. In the near term, we also have to talk about the influence of the meme stock phenomenon, which appears to be resurfacing in 2025. We have seen chatter on social media platforms, specifically Reddit and X, where retail traders are identifying BYND as a deep value asymmetry play. The logic is simple. The MAC cap has fallen so low that it doesn't take much capital to move the needle. A few viral posts, a coordinated buying effort, and suddenly you have a self-fulfilling prophecy of price appreciation. We are seeing early signs of this today with the 19% move on no specific company-issued news. This is characteristic of a momentum ignition, where technical traders see the breakout and pile in, forcing the algos to chase. If you are trading this, you are trading psychology, not fundamentals. You are betting on the greater fool theory, that you can sell your shares to someone else at a higher price before the music stops. There is also a macro angle here regarding the food supply chain. We are seeing continuing fluctuations in livestock prices due to feed costs and climate events. If beef prices spike again due to a drought in the Midwest or supply chain disruptions,